The most hated big tech stock in 2026. In 2022, Wall Street hated Meta because Mark Zuckerberg burned $10 billion on the metaverse. They said he was lighting money on fire. Fast forward to January 2026, the stock is down 15% from highs and the hate is back. Why? Because the price tag just added a zero. According to a new note from TD Cowen, Meta's capital expenditure for 2026 is projected to hit $125 billion. Let that sink in. That is a 76% increase from last year. It is more than the GDP of most countries spent entirely on NVIDIA GPUs, custom silicon, and nuclear power plants. Investors are terrified. They see uncontrolled spending that will suffocate free cash flow. But are they missing the forest for the trees? Today, we are stripping away the emotion. We are running Meta platforms through the Analyst's verification test. We look at three numbers: revenue quality, cash flow reality, and ROIC. By the end of this video, you will know if this dip is a trap or the buying opportunity of the decade. If you are new to this channel, welcome. This is Joe from the Investment Diary. I have been investing for the past more than 5 years and have consistently beat the market in the past 3 years with more than 20% annualized returns. I have traded Forex, commodities, stocks, and options, made painful mistakes and punished by the market, and I would like to share my lessons and journey of investing with you in this channel so we can both supercharge our investments. Support me by tapping on the like and subscribe buttons. Chapter 1. Moat Analysis, the 3.5 billion human firewall. First, let's look at the business. Has the moat crumbled? Absolutely not. In fact, it's deeper than ever. In Q3 2025, Meta recorded 3.54 billion daily active people, DAP. That is nearly half the planet logging into Facebook, Instagram, or WhatsApp every single day. But the user count isn't the real story. The story is the data moat. In June 2025, Meta finalized a massive $14.8 billion investment to acquire a 49% stake in Scale AI. Why does this matter? Scale AI is the leader in data labeling, the ground truth needed to train AGI. By locking this down, Meta didn't just buy software, they bought the textbook that every other AI model is trying to study. And they are solving the biggest bottleneck of 2026, energy. Just days ago, Meta signed a deal with Oklo for up to 1.2 gigawatts of nuclear power. While competitors are waiting for the grid to catch up, Meta is building its own power plants. The verdict? The moat is wide, nuclear-powered, and holds the world's largest social graph. The execution layer moat. Why Meta bought Manus AI for $2 billion. While the market obsessed over the $14.8 billion Scale AI stake, the data moat, the $2 billion acquisition of Manus AI in December 2025 went largely unnoticed by retail investors. This was a mistake. Manus is not just another chatbot company. They are the execution layer that Zuckerberg has been missing. Number 1. The action gap. For the last 3 years, AI models like Llama have been excellent at talking, generating text, but terrible at doing, executing complex, multi-step workflows. If you asked an AI to audit my last 50 invoices and email the discrepancies to accounting, it would hallucinate or fail. It lacked a body in the digital world, a way to click buttons, open files, and navigate browsers. Number 2. The solution. Agentic AI. Manus AI fills this gap. Unlike standard LLMs, Manus operates on a virtualization-first architecture. It creates ephemeral, cloud-based virtual computers, sandboxes for every task. The tech doesn't just predict the next word. It spins up a secure Linux environment, opens a browser, logs into a portal, downloads a CSV, and runs Python code to analyze it. The scale? Before the acquisition, Manus had processed over 147 trillion tokens and powered 80 million virtual sessions. It is battle-tested agentic AI. Number 3. The strategic integration. WhatsApp as an OS. Meta is integrating Manus directly into WhatsApp Business and Workplace. The vision? WhatsApp shifts from a messaging app to a service OS. A user can text a business, "Book me a dentist appointment for next Tuesday," and the Manus agent doesn't just reply, "Okay." It actually accesses the dentist's calendar software, finds the slot, books it, and adds it to your calendar. The moat? This creates high switching costs. Once a business builds their operations on Meta's action agents, they cannot leave for a cheaper ad platform. They are operationally locked in. Number 4, the risk, Singapore washing. The deal is without peril. Manus was originally founded in China by Butterfly Effect Technology before relocating its HQ to Singapore in 2025 to avoid sanctions, a practice known as Singapore washing. Regulatory hazard? The acquisition is currently under review by both US and Chinese authorities. If blocked, Meta loses its action layer. If approved, Meta gains a 12-month lead on Google in the race for true autonomous agents. Summary: the Manus acquisition converts Meta's ecosystem from passive consumption to active execution. It is the final piece of the utility moat. Chapter 2: Financial Health. The verification test. Now, let's look at the numbers. We use the Analyst's verification test to see if the business is actually healthy. Pillar 1, revenue quality and growth. The metric, 3 years CAGR greater than 10%, organic versus inorganic. First, revenue. Is Meta growing because it's good or because it's buying companies? Q3 2025 revenue came in at $51.2 billion, up 26% year-over-year. This beats our 10% benchmark easily. Crucially, this is organic growth. Ad impressions are up 14%, and the price per ad is up 10%. This means the AI algorithms, Lattice, are working. They are putting better ads in front of people, and advertisers are willing to pay more for that performance. Pillar 1, pass. Pillar 2, cash flow reality, the truth metric. The metric, free cash flow margin greater than 10%. Here is where it gets ugly. This is the pillar of pain. Operating cash flow is strong at roughly $30 billion per quarter, but remember that $125 billion CapEx number? If Meta spends $30 billion a quarter on CapEx, their free cash flow, FCF, drops to near zero. In Q3 2025, FCF was $10.6 billion, a 20.7% margin. That passes our test today. But if the 2026 forecast holds true, that margin is going to collapse. Wall Street hates uncertainty, and right now, the cash flow future looks like a black hole of GPU spending. Pillar 2, caution/watch. Pillar 3, capital efficiency, ROIC. The metric, ROIC greater than 15%. This is the most important number. Is Zuckerberg burning cash or investing it well? We look at return on invested capital, ROIC. As of Jan 2026, Meta's ROIC is sitting at 21.2%. This is elite. For every dollar of capital, debt plus equity in the business, they generate 21 cents of profit. Even with the massive spending, the core ad machine is so efficient it covers the bill. As long as this number stays above 15%, the spending is justified. Pillar 3, pass. Chapter 3, Management Performance and Strategy. The Founder Mode Premium. Why Zuckerberg is betting the farm again. While Wall Street focuses on the terrifying $125 billion CapEx figure, they are missing the qualitative shift in how Meta is being run in 2026. Mark Zuckerberg has transitioned the company from the year of efficiency, 2023 to 2024, to what internal memos are calling the year of velocity. This is no longer a social media company. It is a nation-state operating with a wartime CEO mindset. 1. The nuclear pivot, infrastructure sovereignty. Management has correctly identified the single biggest threat to their existence, the power wall. The problem, in 2025, data center expansion hit a physical limit. The U.S. power grid simply could not support the gigawatt-scale clusters needed to train Llama 5. Google and Microsoft are fighting over the same constrained grid capacity. The management move. The partnership with Oklo to deploy small modular reactors, SMRs, is a masterstroke of vertical integration. By securing their own off-grid power source, management has de-risked the company from public utility failures. They are treating electricity as a core supply chain component, not a utility bill. Analyst take is this is CapEx heavy now, but OpEx light later. While competitors face volatile energy prices, Meta is locking in fixed energy costs for 20 years. 2. Cultural reset. Output over effort. Zuckerberg has fundamentally altered the compensation and review structure for 2026, creating a sharper divide between builders and managers. The L6 Cliff. Reports indicate a massive thinning of middle management, level 6 and above. The directive is clear. If you are not writing code or selling ads, you are latency. The shipped metric. Performance bonuses are now tied heavily to deployed AI features rather than research papers. This explains the rush to integrate the Manus AI agentic features into WhatsApp. The culture has shifted from move fast and break things to move instantly and automate things. The risk is this high-pressure environment risks burning out top talent. However, the retention rate for technical AI talent remains high because Meta offers the one thing researchers want most: infinite compute. 4. Capital allocation, the buyback floor. Despite the record spending, management has not abandoned the shareholder. The signal: the board authorized a fresh $40 billion share repurchase program in late 2025. The interpretation: this is the ultimate put option. Management is effectively saying, we will spend $125 billion on AI, but if the market punishes our stock price too much, we will use our cash pile to buy back our own shares at a discount. This creates a soft floor for the stock price, signaling that management believes the market is undervaluing their long-term assets. The 4. The open-source scorched earth strategy. Zuckerberg's insistence on open-sourcing Llama 4 and 5 is not altruism, it is a ruthless management strategy to commoditize the competition. The play: by giving away state-of-the-art models for free, Meta destroys the business models of closed-source competitors like OpenAI or Anthropic, who sell access to models. The benefit: this forces the entire developer ecosystem to standardize on Meta's architecture, PyTorch and Llama. When the industry standardizes on your tools, you own the ecosystem, even if you don't charge for the tools themselves. Zuckerberg is the only big tech CEO with the voting control to ignore short-term earnings pressure. In 2026, he's using that control to force a brute force victory in AI. It's expensive, terrifying for the risk-averse, but historically, betting against Zuckerberg's paranoia has been a losing trade.
Chapter 4. Fair Value Estimate, DCF Model. So, what is the stock worth? Everyone has an opinion, but math is what matters. I ran a two-stage discounted cash flow model with 3 scenarios for 2026. First, the bear case. If Zuckerberg spends $125 billion on AI, but the revenue from Llama 5 is 0, margins will collapse. In this scenario, assuming revenue growth slows to 10%, the fair value is $538 per share. If you believe AI is just hype, the stock is currently overvalued. Second, the base case. This assumes the spending happens, but it efficiently boosts ad prices by 10 to 15%. Meta maintains dominance and cash flow recovers in 2027. In this scenario, the fair value is $680 per share. This suggests the stock is currently fairly valued to slightly cheap. Third, the bull case, the AGI monopoly. If the Manus AI acquisition works and WhatsApp becomes the global service OS, ad pricing power explodes because Meta is the only one with the compute to run real-time agents for 3.5 billion people. In this scenario, assuming 17% revenue growth and recovering margins, the fair value is $835 per share. Conclusion and next steps. To wrap up, Meta is the most hated stock because the bill for the future has arrived. $125 billion is scary, but the verification test doesn't lie. 1. Revenue is organic and accelerating, 26%. 2. ROIC is elite, 21%. 3. The moat is protected by nuclear power and 3.5 billion people. The market is currently pricing Meta somewhere between the bear and base case. It is pricing in fear. If you believe that Mark Zuckerberg, the man who pivoted to mobile in 2012 and stories in 2018, will fail this pivot, sell the stock. But if you look at the math, it suggests the $125 billion isn't a cost, it's a wall that competitors can't climb. If you can stomach the volatility of a high spending year, the fundamentals scream long-term compounder. But if you need safe, steady cash flow today, look elsewhere. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.